If you're over 65, the way you use your bank account could quietly be putting your savings, your independence, or even your eligibility for certain benefits at risk. And most of these mistakes don't show up as a problem until it's already too late to fix easily. Today, I'm walking you through 5 specific banking mistakes that trip up retirees more than almost any other age group. You'll learn which common account setup can accidentally disqualify you from certain benefits, why the way you name a beneficiary matters more than most people realize, and one everyday habit that scammers specifically target once you're past 65. Before we continue, make sure you subscribe to Golden Wealth Mindset for the latest VA benefits updates. And let me know in the comments, where are you watching from today? Mistake number 1 is keeping all your money in a single account at a single bank, especially if that balance creeps above $250,000. Here's why that matters. FDIC insurance protects your deposits, but only up to $250,000 per depositor, per insured bank, per ownership category. If you've spent decades building savings and it's all sitting in one checking or savings account at one institution, anything above that threshold isn't federally insured if something goes wrong with the bank. This isn't about assuming your bank is unstable. It's about making sure you're protected no matter what. The fix is simple. Spreading funds across different banks or using different ownership categories like individual versus joint accounts can extend your coverage significantly. A lot of retirees are surprised to learn this rule exists at all, because nobody at the bank tends to bring it up voluntarily. Mistake number 2 is adding an adult child to your bank account as a joint owner without fully understanding what that actually means legally. This is one of the most common things I see, and it comes from a good place wanting a trusted child to help manage bills or handle things if you become unable to. When you add someone as a joint account holder, they legally own that money right alongside you, immediately, not just after you pass away. That means the funds could be exposed to that child's creditors, included in their divorce proceedings, or accessed by them without your permission, even if your intention was only for emergencies. A safer alternative that accomplishes the same goal is setting up power of attorney, or adding what's called a payable on death designation, which gives someone access only when it's actually needed without handing over ownership today. Now, here's a mistake that connects directly to something a lot of retirees don't think about until they're filling out paperwork for Medicaid or supplemental security income, and it's coming up next, because it trips up more people than you'd expect. Mistake number 3 is letting money accumulate in a checking account without understanding how it affects asset-based benefits. If you're receiving or ever plan to apply for SSI, or you're planning ahead for potential Medicaid long-term care coverage, these programs have strict asset limits. SSI, for example, generally limits countable resources to $2,000 for an individual. A lot of people don't realize that money sitting in a checking or savings account counts toward that limit. And simply having too much cash on hand, even money you're not actively using, can make you ineligible. This doesn't apply to everyone. If you're only receiving Social Security retirement benefits or Medicare, there's no asset limit tied to those specifically. But if SSI or Medicaid is part of your picture now, or could be down the road, this is exactly the kind of detail worth reviewing with a benefits counselor before a balance quietly disqualifies you from something you're counting on. Before we continue, make sure you subscribe to Golden Wealth Mindset for the latest VA benefits updates. And let me know in the comments, where are you watching from today? If you're finding this useful, go ahead and hit like and subscribe. I break down exactly this kind of practical, no-nonsense financial guidance for retirees regularly. And it genuinely helps more people find these videos when you do. Mistake number 4 is one that scammers specifically bank on, no pun intended, keeping outdated contact information and skipping account alerts. Financial abuse and scams targeting people over 65 have become alarmingly common. And one of the biggest reasons fraud goes unnoticed for weeks is that the account holder never gets a real-time alert when something unusual happens. Most banks now offer free text or email alerts for withdrawals over a certain amount, login attempts, or unusual activity. Yet a lot of retirees either never set these up or set them up years ago with an old phone number or email that's no longer active. Take 10 minutes this week to log into your account and confirm your alerts are turned on and your contact information is current. This single step is one of the fastest ways to catch fraud within hours instead of months. Some people believe that if fraud happens on their account, the bank will automatically catch it and reverse everything with no effort on their part. That's not guaranteed. For unauthorized electronic transfers, federal protections under the Electronic Fund Transfer Act do exist. But your level of protection often depends on how quickly you report the unauthorized activity. Waiting even a couple of months to notice and report a problem can significantly reduce how much you're able to recover. This is exactly why those alerts from mistake number 4 aren't just a convenience, they're a financial safety net. Now let's talk about mistake number 5. And this is the one I'd call the most overlooked, because it has nothing to do with fraud or fees. It's about what happens to your account after you're gone. And getting it wrong can cost your family months of stress and legal expenses they didn't need to go through. Mistake number 5 is never setting up a beneficiary designation or payable on death instruction on your accounts. Here's what most people don't realize. Even if you have a will, a bank account without a named beneficiary typically has to go through probate before your family can access those funds. Probate can take months, sometimes over a year. And it often comes with court fees and legal costs that eat into the very money you work to leave behind. Setting up a payable on death, or POD, designation, is usually free, takes just a few minutes at your bank, and allows the named person to access those funds directly, often within days of providing a death certificate, completely bypassing probate. This is different from a joint account, and it's actually the safer option I mentioned earlier. It gives you full control and full ownership while you're alive, and only transfers when you pass away. A POD designation on a bank account will override what your will says every single time. So if you wrote a will years ago, dividing your assets one way, but your bank account still lists an old POD beneficiary, maybe an ex-spouse or a sibling who's since passed away, or just an outdated choice, that account will go to whoever is listed on the POD form, regardless of what your will says. This is one of the most common and costly oversights in estate planning. It takes just a phone call or a quick trip to your bank to review and update these designations. And doing it today could save your loved ones from a legal headache during an already difficult time. Before we continue, make sure you subscribe to Golden Wealth Mindset for the latest VA benefits updates. And let me know in the comments, where are you watching from today? One more thing worth mentioning here because it ties several of these mistakes together. Retirees sometimes assume that once their accounts are set up, the job is done, but your banking situation should get a checkup periodically, especially after major life events like the death of a spouse, a new grandchild you might want to add as a beneficiary, or a move to a new state, since state laws around POD accounts and probate can vary. A once-a-year review, maybe when you're already doing your taxes, is a simple habit that keeps all of this current without requiring much extra effort. So, let's bring it all together. The 5 mistakes we covered are keeping too much money in one bank beyond FDIC coverage limits, adding a joint owner without understanding the legal risks, letting cash accumulate in ways that jeopardize asset-based benefits like SSI, skipping fraud alerts and letting your contact information go stale, and never setting up or updating a payable on death beneficiary. If you take away just one thing from this video, let it be this. A payable on death designation is one of the simplest, most powerful protections available to you, and it costs nothing but a few minutes of your time. The action to take today is to call your bank or check your online account and confirm exactly who is listed as your beneficiary on every account you hold. Not who you think is listed, but who's actually on file right now. You've spent a lifetime building this financial foundation, and a few small adjustments today can make sure it protects you and the people you love, exactly the way you intended. Take care of yourselves, and I'll see you in the next one.